All right, so trying to keep up with what the Fed's doing these days, it can feel like you need like an economics degree just to understand the headlines.
It definitely can be a bit complex.
That's why we're here, though. We're going to
Right.
break down their latest statement, which is basically the Fed's way of telling us like what they're seeing in the economy and what they're planning to do about it.
And what's particularly interesting right now is the Fed is in this tricky spot. They're trying to keep things growing, but they also don't want inflation to get out of control.
Yeah, it's a tough balancing act for sure. So the big news is the Fed just lowered interest rates by a quarter percent.
Right, 0.25%.
So what's the thinking there? Are they just trying to give the economy a little boost?
Exactly. Think of it like this. Lowering rates makes it cheaper to borrow money. For businesses, that means they might invest more, and for us, well, it could mean we're a bit more willing to spend.
Okay, that makes sense. But doesn't lowering rates usually make inflation worse?
It's a risk, for sure. It can stimulate the economy, but if demand gets too high and supply can't keep up, then yeah, we could see prices jump. That's the tightrope they're walking.
So how do we know if things are heating up too fast? Like, what are the signs we should be looking for?
Right. Well, the Fed's report actually gives us some clues. First up, GDP, how much the economy grew. It was 2.8% this quarter.
Same as last quarter, right? So is that good, bad, or just kind of,
I'd say it's decent. I mean, it shows the economy is not collapsing, but it's not exactly booming either.
okay, steady but not spectacular. What about jobs? Are people finding work?
Yeah, the report shows an average of 104,000 new jobs each month over the last 3 months, which is good news.
That is a lot of new jobs.
It is, but there's also a catch. Wage growth has slowed down.
So jobs, but maybe not bigger paychecks.
Yeah, could be a sign the labor market is losing a little bit of its momentum.
Interesting. Okay, let's talk about the thing everyone's worried about, inflation. The report says it's down to 2.1% overall.
Which is close to the Fed's target, yeah.
Yeah. But then they mentioned this core inflation number, which is still at 2.7%. What's the difference?
Core inflation takes out volatile prices like food and energy. It gives the Fed a better sense of the underlying trend.
So are they more worried about the core number then?
If it stays high, it could mean price increases are getting baked into the economy, and that makes inflation much harder to control.
Okay, so the Fed's kind of playing doctor here, trying to keep the economy healthy. And they keep mentioning this dual mandate thing. What's that all about?
Ah, the dual mandate. That's their main objective. Maximum employment and price stability. Basically, they want as many people working as possible without letting inflation run wild.
Sounds like it could be tough to do both at the same time.
It definitely can be. The Feds also said they're taking a data-dependent approach, which basically means they're going to be watching the numbers closely and adjusting their strategy as they go.
So no set plan.
No autopilot. They're making decisions based on what the economy is telling them.
Okay, so if we want to try to guess what the Fed's going to do next, what data should we be looking at?
We'll definitely keep an eye on job growth. Is it staying strong or is it starting to slow down? And wage growth, are wages keeping up with prices? And of course, inflation, both the overall rate and that core number we talked about. If any of those start flashing warning signs, the Fed might change course.
So basically, we need to be economic detectives, looking for clues to figure out what's going to happen next.
Exactly. And that's where things get really interesting because the Fed's decisions don't just affect the economy as a whole, they can have a real impact on our everyday lives too.
Okay, so let's get down to brass tacks. What does all this Fed stuff actually mean for, the average person listening?
Let's think about it. For example, interest rates on loans. If the Fed keeps lowering rates, you might see lower rates on mortgages, car loans, things like that.
I'm no financial advisor, but if I was thinking about buying a house, I'd definitely be watching those mortgage rates.
Yeah.
What else could be affected?
The stock market is another one. Lower interest rates can sometimes make stocks more attractive to investors, but it's not always a simple relationship.
So, good for borrowers, maybe good for investors. But what about people looking for jobs? What does all this mean for the job market?
Well, if the Fed's moves keep the economy growing, then we could see more jobs being created. But if they go too far and inflation gets out of control, then they might have to raise rates again. And that could slow down the economy and make it harder to find a job.
So, a lot of uncertainty.
There's always uncertainty in economics, but the Fed's being very careful, trying to find that sweet spot where the economy is growing but not overheating. They're watching out for two big risks, actually.
Oh, and those are?
One is inflation coming back with a vengeance, and the other is the economy slowing down too much. They're trying to find that Goldilocks zone, not too hot, not too cold.
Makes sense. But it's not all up to the Fed, right? There are other things that can affect the economy too, like what the government does with spending and taxes.
Oh, absolutely. That's called fiscal policy, and it can have a huge impact, either working with the Fed or pushing in the opposite direction. It's kind of like a tug of war.
A tug of war with the entire economy at stake. Well, we're definitely going to dive deeper into that in part 2 of this deep dive. But for now, it sounds like the Fed's trying to steer us through some pretty choppy waters.
It's definitely a challenging time, that's for sure. But the more we understand what they're doing and why, the better equipped we'll be to navigate it all.
Absolutely. Stay tuned for part 2, where we'll unravel more of this economic mystery.
Welcome back. It's really kind of wild when you think about it. The Fed makes these decisions, and they can end up affecting, like, everyone.
It's true, their reach is massive. But like you were saying before the break, it's not just the Fed calling the shots. We got to talk about fiscal policy, right? The government's role in all this.
Right. Imagine the Fed's trying to, I don't know, maybe slow down the economy a bit.
Yeah.
And at the same time, the government's launching all these huge spending programs.
So they could be working against each other.
Exactly. Like one's hitting the gas, the other's tapping the brakes. It can make things pretty unpredictable.
A recipe for economic whiplash.
You could say that. It makes the Fed's job even harder trying to steer the economy when you've got these other forces at play.
Okay, so big picture, we got to keep an eye on both monetary policy and the fiscal policy to really understand what's going on. But sticking with the Fed for now, what are some of the potential downsides to what they're doing? Like, are there any risks to lowering interest rates?
Oh, definitely. I mean, one concern is that it could actually make inflation worse. Like, if it gets too easy to borrow money, people might start spending like crazy, and if businesses can't keep up with that demand, well, prices go up.
Too much money chasing too few goods.
Hmm.
Classic inflation problem. What else? Are there other risks the Fed's worried about?
Yeah, another one is asset bubbles. Like, lower interest rates can make things like stocks and real estate look really attractive to investors. But if prices rise too quickly and they're not really based on, actual value, it could create a bubble. And when bubbles burst,
Yeah.
no, not good at all. Could lead to a big drop in asset values and maybe even some instability in the financial system.
So the Fed's got to be super careful finding that balance between stimulating the economy and like not setting off a ticking time bomb.
Speaking of things that could go wrong, there's been a lot of talk about a potential recession. Is that something the Fed's worried about?
Oh, for sure, they're paying attention to those concerns. But I wouldn't say they're panicking, at least not yet. I mean, the moves they're making, like lowering interest rates, are designed to help keep the economy growing. They're trying to steer us away from that recessionary cliff.
But it seems like there's so much that could push us one way or the other. How do we even make sense of it all? Like, how do we figure out what's likely to happen?
Well, you got to try to filter out the noise and focus on the fundamentals. Like what's happening with job growth? What about consumer spending? Are businesses investing? And of course, inflation. Those are the vital signs that can tell us a lot about the health of the economy.
So we're like economic detectives. Exactly. We got to gather the clues, analyze the evidence, and try to piece together the most likely scenario.
But isn't economics kind of notoriously unpredictable?
It definitely can be. There are always going to be surprises, things you just can't foresee. It's not an exact science.
To no crystal ball.
Nope, no crystal ball. But we can still try to make sense of things. And that's why it's so important to stay informed, keep up with what's happening, but don't get too caught up in the day-to-day headlines.
Don't panic.
Exactly. The economy goes through cycles. It's constantly changing. What looks like a crisis one day might be a distant memory a few months later.
Okay, that's reassuring. So back to the Fed. What else can they do besides messing with interest rates? Like what other tools do they have?
Well, they can buy or sell government bonds. It's called open market operations.
Catchy.
Yeah. Well, economists aren't exactly known for their creativity. But anyway, it can affect how much money is circulating in the economy. And they can also change reserve requirements for banks.
Reserve requirements.
Yeah, basically how much money banks have to keep on hand, which affects how much they can lend out.
So they've got options, but it's not like they can just flip a switch and make everything perfect, right?
No, it's definitely not that simple. The economy is this massive, complex system, and the Fed's actions take time to have an effect. It's not like steering a little speedboat. It's more like a giant supertanker.
So they're trying to steer this supertanker through a fog with limited visibility and no guarantees about what's coming next.
Pretty much. And don't forget, they're not the only ones trying to influence the economy. You've got governments, global markets, all these different players with their own agendas.
It's like a high-stakes game of economic chess. So, to wrap up this part of our deep dive, what's the main takeaway for our listeners?
I think the biggest thing is just to remember that the Fed's actions are only part of the story. The economy is constantly evolving, and there are so many factors that can affect it. So stay informed, but don't get overwhelmed.
Great advice. And we'll be back soon for the final part of our deep dive, where we'll explore some of the broader implications of all of this and what it could mean for the future. All right, welcome back for the final part of our deep dive into the Fed. So, we've talked about their latest moves, we've talked about this balancing act they're trying to pull off, and how sometimes they might even be working against what the government's doing. But what about the big picture? Like, what are the long-term consequences of all these decisions?
Well, that's where things get really interesting. I mean, what the Fed does today can have ripple effects for years, even decades to come. It's like setting off this chain reaction, and we might not see the full impact for a while.
So it's not just about reacting to what's happening right now.
Right. They're trying to guide the economy onto a sustainable path, but it's not easy. It's like trying to predict the future, and there's always a chance you'll get it wrong.
And there's so many things they can't control, right?
Yeah.
Like what's happening in other countries or some unexpected event that throws everything off.
Exactly. The Fed's not all powerful. They can't control everything, but they have to make decisions based on the information they have.
Okay, so zooming out even further, what are some of the big trends, the big challenges that are facing the economy in the long term?
Well, one that's already having a huge impact is technology, right? I mean, automation, artificial intelligence, it's changing the job market like crazy. Some jobs are disappearing, new ones are popping up, and it's happening so fast.
It's kind of exciting, but also kind of scary, Like, what skills are even going to be relevant in 10 years?
That's the million-dollar question. Education and retraining are going to be so important, making sure people have the skills they need for these new jobs.
Yeah, we got to make sure people aren't left behind. It can't just be about, like, growth at all costs. It has to be about opportunity, too, right?
Absolutely. A healthy economy is one that works for everyone. And speaking of challenges, we can't forget about climate change. I mean, that's a big one, and it's only going to get bigger.
Yeah, the elephant in the room. How does that factor into all this?
Well, it poses a huge risk to the global economy. We're already seeing it. Extreme weather, rising sea levels, disruptions to agriculture. It's costing us money, and it's only going to get worse.
It feels like there's a shift happening, though,
Yeah.
right? Like, more and more people are realizing that economic growth and sustainability have to go hand in hand.
Definitely. Investing in clean energy, sustainable technologies, that's not just about saving the planet. It's about creating economic opportunities, too.
So, as we look ahead, it seems like there's a lot of uncertainty, a lot of challenges, but also a lot of potential, right?
Mm.
What advice would you give to our listeners as they try to navigate all of this?
Stay informed, stay curious, and be adaptable. The economy is always changing, but the more we understand it, the better prepared we'll be for whatever comes next.
And remember, even though the Fed is powerful, they're not the only ones shaping the economy. We all have a role to play.
Exactly. So stay engaged, stay informed, and keep asking questions.
That's all for this deep dive. Thanks for joining us, and we'll see you next time.